The most helpful investment stat you've never heard of. Dateline September 13th, 2020 by Rob Isbitz, who's a hedge investor mythbuster at thehedgeinvestor.com. I've never heard this ratio. It's called the Kalmar Ratio. All right. You've probably not heard of Terry Young, which I have not, and you're likely not to have heard of the Kalmar Ratio, which he invented 30 years ago. But I tell you what it measures in an investment's past performance, you might remember for a long time. It takes the average annual return of an investment over the last 36 months and divides it by the maximum drawdown that investment has experienced during that 3-year period. That original formula has been adapted to different time periods over the years, but the concept is the same. Well, come on, man. When you're adapting a original formula, how do you adapt original formula? Have they adapted the Sharpe ratio? Yeah. How do you adapt an original formula? I'm trying to think. Do they adapt? I guess they did adapt the CAPE, cyclically adjusted price earnings ratio from Bob Shiller, which, anyway, so they adapted it. I mean, can you adapt PE ratios? I guess you can adapt the GAAP, the generally accepted accounting, what's P? Procedures, policy, something like that. But the PE itself hasn't been adapted. I don't get price to book, not adapted. Price earnings, price sales? No, I don't like that. The original formula has been adapted to different time periods. Okay, so that sounds like to me is rear view looking, so it's going to work 100% of the time. Pretty simple and a very powerful analytical tool for hedge investors. The higher the ratio, the better the past reward to risk trade-off that security has exhibited. That's the past. Okay, let's keep it. That doesn't make any sense to me. The better it did in the past. Okay. Any investment can achieve very high returns over a few years. In fact, one of the basic assumptions of our rating system is that any investment has the potential to produce positive returns over any time period. What separates the wheat from the chaff is how much risk is attached to that potential return. And of course, when making investment decisions, we're trying to look forward. After all, the one thing we can guarantee about past performance is that we can't have it. It's all in the past. However, since we can't predict the future and we are concerned with avoiding big losses, it helps to have something that looks at the past that way. And this is a Kalmar in action. To help us make some assessments of today's market environment, this chart shows a 5-year rolling Kalmar for 4 different indices: the S&P, the NASDAQ, Russell 2000, and MSCI emerging markets. All right. Okay, so we have a Kalmar of the NASDAQ at 0.67, S&P 0.3, Russell 2000 0.16, emerging markets at 0.15. As you can see, the clear winner of the past decade was the NASDAQ. Okay. Its Kalmar ratio doubled that nearly of the S&P 500 and more than 4 times that of small caps or emerging market stocks. Think about that for a moment. These are all the stock market indexes, and the NASDAQ is supposed to be one of the risky ones. But for the past 10 years, it's been consistently been worth whatever major declines might occur all along. However, if we turn back the clock and look at the 10 years prior to that, we see something different. The MSCI was the highest rated Kalmar thing. The NASDAQ was a negative 0.01. The MSCI is 0.18. The NASDAQ, S&P, and Russell are all quite low. This indicates that your upside during this period was quite poor compared to how much you would have lost when the wind was against you. The emerging markets index was a step above, so the better. So what do you want? You want the lowest one? No, he said you want the highest. But then what? The NASDAQ, this indicates your upside during this period was quite poor compared to how much you would have lost when the wind was against you. The emerging market was a step above, so risk was better rewarded there, but these are still pretty low. These are just a snapshot, but you can be confident this is not the last you've heard from the hedge investor when it comes to the Kalmar ratio to evaluate investment markets. After all, the NASDAQ and S&P are near all-time highs and interest rates are near zero. So the times demand that you put a premium on managing a portfolio that can help avoid big losses while still providing potential upside. Literally, I don't understand what this guy's saying. The clear winner of the Kalmar was Nasdaq, but the clear winner of the Kalmar back then was emerging markets. But you would have bought the emerging markets, you would have got skunked. I'm this doesn't make any sense to me. What does he say about the Kalmar? What are you looking for again on this? As investment, in fact, of course, when making investment, we are trying. However, since you can't, okay, it helped. Nasdaq. Okay, as you can see, the clear winner more than nothing. But okay, so what are we trying to find? The higher the Kalmar, the better. This doesn't make any sense to me. This charge for the 5-year. Okay. Any investment that can. Okay, That makes no sense to me at all. I'm at a loss, man. So let me pause real quick. Yeah, he says right here, the higher the Kalmar ratio, the better the past risk reward trade off that index is. I literally don't get what he's making here. Am I missing something? This makes no sense because he's saying that's what it did in the past, but then, okay, that's what it did in the past, but too late for you. And then you say, okay, well, here's what it did the previous 10 years. So if you would have bought the S&P 500 with its lowest Kalmar, you would have been heavily rewarded. So does that mean you should buy the emerging markets and small caps now? Dude, I'm at a loss. I am at a loss. Okay, so this, I don't think they have comments on Forbes. No, they don't. I don't know, my friends. That is just an odd article to me. I would stay clear of the Kalmar because that literally makes no sense to me. If you got comments, love to hear them. Thanks now.